Good afternoon. My name is Dr. Fasasi Kazim Adiola. I'm popularly called FA Kazim. My area of specialization centered on financial accounting, cost accounting, advanced financial accounting, cost and management accounting, and taxation. The lecture series will be on Introduction to Financial Accounting. Introduction to Financial Accounting will be good for university, polytechnic, colleges of education, and students offering accounting in colleges. The course outline on Introduction to Financial Accounting 1 include definition of bookkeeping, definition of bookkeeping. Also, it includes definition of accounting, definition of accounting. We'll also be looking at accounting process, We'll also be looking at users of accounting information. Users of accounting information, we'll be looking at it. In this lecture series, we'll be looking at accounting concept and convention. Accounting concept and convention. In the lecture series, we'll also be looking at what we refer to accounting cycle. Accounting cycle. We'll also be looking at capital and revenue expenditure. Capital and revenue expenditure. Also, we'll be looking at accounting equation. Accounting equation. We'll be looking at brief history of accounting, and we'll also be looking at double entry bookkeeping, and trial balance. After this, we'll be looking at calculation on books of account, and also we'll be looking at correction of errors, and we're going to end this lecture series with bank reconciliation statement. Bank reconciliation statement. At the end of this lecture series, students will be able to attempt any university, colleges exam, or even professional examination body. You will be able to attempt question on all this area. Today, we'll be looking at definition of bookkeeping, definition of accounting, and users of accounting information. Let's start today's lecture. Today's lecture will be centered on definition of bookkeeping, definition of accounting, accounting process, and also users of accounting information. Let's start with definition of bookkeeping. Definition of bookkeeping. Bookkeeping is defined as art of recording financial transaction financial transaction of any business concerned, of any business concern. What do we mean by this? Bookkeeping is the branch of accounting, and looking at the definition, is an art of recording financial transaction. The reason is this: in every business, the success of every business depend on recording. And what type of recording are we talking about? We are talking about keeping record of monetary transaction that involve what? Money. That's why we can also ask ourselves, this transaction we are talking about, what does it mean? Transaction is an event. Transaction is an event that happened during business. Transaction is an event that happened during business. During business, such as e.g. bought goods, by cash. These are examples of transactions. And if you look at it, in practice, transaction has to do with provision of service and buying and selling of goods. If there's no way of recording, businesses won't know whether they are trading on profit or they are trading on loss. They will not be able to keep track of their receivables. What do I mean by receivable? Track of all goods sold on credit and track of their payables, track of all goods bought on credit. With the help of bookkeeping, it will be easy to keep record of businesses because this record has a way of helping business owners to know whether they are making profit or loss. But if bookkeeping is the branch of accounting, the next question is, what is accounting itself? We have to look at definition of accounting. What is accounting? The accounting we are about to study, what is the definition? This is accounting. We said accounting can be defined as a process of identifying, recording, and analyzing. Classifying and summarizing. Communicating and interpreting financial information to the users in order to inform decision. This is the definition of accounting. The definition of accounting defined as a process. What does this mean? Accounting has to do with steps, something that has to do with stages by stages. In stage 1, we talk about identifying. In stage 2, we talk about recording and analyzing. In stage 3, we talk about classifying and summarizing. In stage 4, we're talking about communicating and interpreting financial information to the users in order to inform decision. The major reason why accounting is being recorded is for those who need the accounting information to take proper decision, because money has been invested in business. And if money is invested in business, the investors need to take adequate decision for the resources put into the business. In that case, if accounting is a process, what are the accounting process? But before we go to the accounting process, I hope you enjoyed this lecture. I hope you like this lecture. If you enjoy how this lecture is going on, please like our video, our YouTube video, watch more of this video and watch more of this lecture series, because it will have great impact in passing your examination and in acquiring more knowledge on introduction to accounting. Let's look at the next objective, which is accounting process. As said earlier, accounting process has to do with stages. What are the stages? The stages are identifying. What are we identifying? We are identifying source documents. What are the source documents? Source documents are receipt, invoice, debit notes, credit notes, and voucher. What are these source documents being used for in practice? When we said source document, we are referring to business document that shows evidence of transaction between two parties. Without evidence of transactions, it will be difficult for accounting record to be kept. Why? Any of the party can deny involvement in those transactions where there is absence of source document. As we can see all the source documents, one of it is receipt. Receipt is an evidence that a cash transaction has taken place between two parties. If you are buying or you are selling, a document has to be issued to show that there's evidence of transaction between two parties. In that case, where the transaction involved is by cash, the seller or the buyer has to issue a receipt as an evidence that goods has been delivered and cash has been paid. In the essence, if cash has not been paid, which means that the goods that we are talking about was sold or bought on credit, receipt has nothing to be issued. You have to issue invoice. Invoice are used for credit transactions. Where there's credit transaction, you have to issue invoice to either acknowledge that the buyer has not paid for the goods or the seller has not received money on goods being sold. Now, there's difference between receipt and invoice. Where a cash transaction took place, receipts are issued. Where a credit transaction took place, invoice are issued. Where goods are returned back to supplier, debit notes are received from the supplier as evidence that part of the goods has been returned back to the supplier. And when goods are also sold to customers and customer return part of the goods, a credit note is issued to that customer. To record small expenses that receipt cannot capture, invoice and voucher are issued. Let's run this again. Receipts are source documents showing evidence of cash transaction. Invoice is also a source document showing evidence of transactions on credit. Debit note is also a source document received when goods are returned back to the supplier. While credit note is also a source document issued to the customer when goods are returned by the customer as a result of damage or where customer accounts are being overcharged. Well, voucher is one of the special source documents. Voucher can be used to legalize payment, and voucher can also be used to acknowledge expenses incurred that are of small value. From this, if accountant has identified this source document, has known that there's evidence of transaction, the next process for the accountant is the next steps is what? Recording. What is the accountant recording? Accountants are recording in the subsidiary book. Accountant records in subsidiary books. What are subsidiary books? Subsidiary books are books of original entry where transactions are first recorded from the source document. What are these subsidiary books? When you sold goods by cash, you record it in the cash book. Meaning, receipt goes with cash book. Where you issue receipt is telling you that the record should be kept in the cash book. But where invoice are issued, it shows that this record should be kept either in the sales day book when you are selling on credit or in purchases day book when you are buying on credit. In that case, invoice goes with sales day book or purchases day book. When goods are sold on credit, you issue sales invoice and you kept the record in sales day book. But if goods are bought on what? Credit, you receive a purchase invoice and the record are kept in purchases day book. Now, when goods are returned back to the supplier, you keep the record in return outward book. Return outward book. Debit note is an evidence that goods has been returned to supplier. And once this debit note is being received, the debit note is being updated in the return outward book. That is the appropriate book when debit note is received. Now, credit note is issued to customer when goods are returned by the customer, and the appropriate book for it is called return inward book. Return inward book shows that goods has been returned by the customer, and in that case, a credit note is an evidence that that goods has been returned, while return outward, return inward is the source document used to record goods returned by our customer. Voucher are being used to update what we call petty cash book. Petty cash book is a subsidiary book used to record all minor expenses in an organization, and minor expenses are being backed with a voucher. Now, this is a process of recording. After recording, all the transaction will be summarized in the trial balance, and from the trial balance, you prepare a final what? Account, and the final account will be given to the users. For what purpose? For decision for decision making. Now, this end of accounting process. If you look at accounting process starts with identifying the source document. From identifying the source document, you keep the record in the subsidiary book, and from the subsidiary book, you summarize all the transaction in the trial balance, and from the trial balance, you prepare a final account. The final account will be used by the users for decision making. Thank you for listening to accounting process. If you enjoyed this video, please like our video and subscribe to our YouTube channel. Our last topic for today will be on users of accounting information. Who are the users of accounting information? Who are those people that needs accounting information for decision making? These users are categorized into two. The users of accounting information, users of accounting information are categorized into two. Firstly, we have the internal user. What do we call internal users? Internal users are those that need accounting information within the organization itself. They are part of the organization. They are part of day-to-day decision of that organization. These users are just three. One, we have the shareholder. or we call them owners of what? Business. Two, we have the management. And three, we have the the employees. Why did they need accounting information? Let's start with the shareholders. Who are the shareholders? The shareholders are the ordinary shareholders. What is their function? They have invested in this company. They have put their resources in this company. What do they need the accounting information for? One, they need it to know how their resources put into the business are being managed by the management. Two, they want to know the financial position of the business, and they can only know the financial position of the business through the accounting information, and the accounting information is contained in financial statement of the company. By seeing the financial statement, it will help them to know the current position of the business in terms of their assets, their liability, and their owner's equity. The financial statement will disclose this, and it will help them to take proper decision, either to invest more in the business or to withdraw part of their resources from the business. This is why we said the shareholder, they need accounting information to know the financial position of the business. Let's look at the management. Who are the management? The management are the board of directors, the chief executive officer, the chief marketing officer, the finance officer. These are the management. Why did they need accounting information? The management who drives the affairs of the company wants to see the accounting information to know the financial position of the business, to compare their current performance with their predetermined performance. What I mean is to compare their actual performance with their planned performance. The financial statement will let them know whether the current performance is better than the projected performance or they are worse than their projected performance. They will be able to know their state of profit, their state of assets, their state of liability, and this will help them to take decision even if the company is not performing well. And even if the company is performing well, it will help them to know what other directions should they put the company to perform better. We also have the employees. Who are the employees? These are the staffs of the organization. They are the one that works for the profit of the organization. The organization cannot function without the employee, and because the employee are key stakeholder in decision making of the company. But why did they need financial statements? Why did they need accounting information? Employee need accounting information to know the current financial position of the business in order to request for better working condition. For instance, employee wants to see the financial statement to know whether to demand for better working condition and also to demand for better welfare. If there's no financial position, it will be difficult for an employee to know the current state of the company, and it will be difficult for them to also ask for a better working condition and welfare. These are the internal users. The shareholder, they need accounting information to know the true financial position of their business. The management, they need accounting information to review their performance and to compare their current performance with their predetermined performance or their projected performance. The employees also need accounting information to assess their the financial position of the business in order to demand for better working condition and welfare. Now, these are the internal users. We also have the external users. And what are the external users? These are users that are not within the organization, but the decision of the organization affects them. And the external users are one, the government. They are external users. Two, the customer slash suppliers. 3. Financial institution. Financial institution. And lastly, the public. These external users, what do they need in organization accounting information? They are not employee of the organization. They don't work with the organization. But why do they need financial statement of organization? For example, the government. When we are talking of the government, we'll be talking of tax authority, who are agents of government. They need company to pay tax, and company cannot pay tax without submitting their financial statements. From their financial statements, tax authority will know whether companies will be able to pay tax or they will not be able to pay tax. It can also assist tax authority to grant companies tax holiday if they discover that this company are contributing to economic development of the country. Let's exempt them from tax for a certain years so that they can be able to improve, employ more people, and expand the economic growth of the country. Without the financial statements, how would the tax authority know the current position of an organization? That becomes a question mark. In that case, the tax authority needs accounting information of organization to know how to assess such organization to tax. Also, under the external users, we also have the customers and the supplier. Who are the suppliers? Those are people that supplies goods on credit to organization. These people need accounting information to know whether the company they are supplying goods to are liquidity strong. They want to check the liquidity position of these companies. Are they sound? A company that worth 1 million naira is requesting for goods on credit worth 50 million naira. How would such supplier grant this kind of request? If the whole of organization asset and liability is 1 million and they are asking a supplier to supply goods worth 50 million naira, it is actually shows that this company may not be able to pay back. How would they know that? The supplier will know this by checking the financial statement of such company, knowing their liquidity position before such request is being granted to supply them goods on what? Credit. Also, the customers who patronize the product of the organization, they also need accounting information to check the continuity of this business in the future. Because if you are selling a product and the company of which you are selling their product, you are seeing that they are reporting loss on yearly what? Basis consecutively for 5 years. That is a signal that in future, this company may liquidate. And if this company liquidate, indirectly as their customer, your own company too as what? Liquidate. Once you see this kind of signal in their financial statement, it's showing you to start looking for alternatives. So that if this company fold up, your own business will not also fold up. Mainly the customer want to determine the continuity of the company through their financial statement. The customer need the accounting information. Also, those who are supplying them goods, they also need the accounting information to check the liquidity position of this business. Number 3, who are the financial institutions? They are banks or other financial institutions that grant loan requests to companies. What do they need? They need the accounting information of company to check their liquidity position. The liquidity position in what essence? Can they be able to meet up paying back of the loan based on their current financial position? Financial institution will request for financial statement of companies to look at all their current positions before loan are being granted. For instance, a company with 50 million naira asset is requesting for 500 million naira loan. How will such company pay back? This can be known through the financial statement to the banks, and that can make the bank to turn down their request. Without financial institutions, you are being advised without financial statement. Financial institution is being advised not to grant loan requests to companies because this will amount to defrauding the financial institution. In that case, if a financial institution will grant loan to companies, the first thing the company has to do is to submit their financial statement so that this financial institution will be able to know the current financial position of this company and their liquidity position before loan requests are being granted. Number four, public. Who are the public? Is it the general public? The answer is no. When we said public, we are talking about host community. Who are the host community? The host community is the community in which this organization is situated. This community have responsibility to the organization, and the organization also have responsibility to the community. One of the responsibility of the host community is to protect the property of the company in their vicinity. And one of the responsibility of the organization is also to provide basic social amenities like borehole water, like building of primary schools to the community as a corporate social responsibility. In that case, the host community wants to see the financial statement of the company within their vicinity to demand for these basic social amenities. Thanks for listening. This is the end of today's lecture. Other topics will be looked at in our next video. Thank you.